Hey guys, and welcome back to the Young Investors Podcast. We're back again with episode 53, and joining me as always is Brandon. How's it going, Brandon?
It's going quite well. I'm excited for today's episode. It's a good time of the year. It's starting to get a little bit warmer and all the earnings are coming out, and it's just good news all around.
Yeah, no, it's always the best time of the year when the earnings are coming out. We've got a lot of earnings reports to talk about today. We're going to talk about Chipotle, McDonald's, eBay, Tesla, and a few others.
Holy moly.
So sit back, relax.
Grab the popcorn.
Yep. Get your popcorn and drink.
Yep.
As you do on a Saturday morning.
Yep. Exactly right. Fire up the popcorn on a Saturday morning. Well, it could be Saturday. It'll be Saturday afternoon at the earliest for our listeners. But yeah, no, it should be a good episode. I'm excited, man. I feel like every company we're going to talk about for like 5 minutes, and then Tesla will be like half an hour. You got to stop me. You got to stop me when we talk about Tesla.
We'll keep an eye on the time. We'll make sure that we don't spend 40 minutes on Tesla.
It very well could happen. Anyway, so should we just get started, I guess?
Yeah, and just before we do get started, today's episode is sponsored by HYPERCHARTS.
Indeed it is. So just like last week, guys, if you don't know HYPERCHARTS is just a website where, if you think about the company's financial statements, HYPERCHARTS just grabs all of the key numbers off of those tricky to read financial statements, and it just puts them all into nice graphs, so you can just compare quarter over quarter over quarter over quarter, or year over year over year over year of just all of the most important financial data from a company. So I use it all the time, and I believe that you've started using it a little bit as well. Is that right?
Yeah, it's a beautiful thing. It's fantastic. I mean, for example, Tesla, we'll start already talking about Tesla, but you can get access to vehicle deliveries, all of the different sort of unique things related to businesses as well, not just the major financials, and that's really useful for looking into companies.
Yeah, it gives you more context than what you would typically get from reading a financial statement, which helps. It does help. Last thing to note as well is that they do have a premium mode. Premium basically unlocks further in-depth charting. You can compare different companies' charts on the very same page. You can download the earnings calendar to your personal smart device. You can get the latest results sent straight to your email address. But best of all, there's a free 2-week trial of Premium. So head over to hypercharts.co. Most of the information is actually completely free. If you wanted to check out Premium, hypercharts.co/premium. And thanks to HYPERCHARTS for sponsoring this episode. All right, let's head into the indices. Should I smash them out?
Go for it.
All right, so we got the Dow was up 0.37%. We've got the Nasdaq up 1.27%, and the S&P up 0.86%. Then over in Australia here, we've got the ASX 200 up 1.3%, and the All Ordinaries up 1.2%. So overall, not too bad of a week in the markets, led, I guess, by the American tech companies, with the Nasdaq being up so much.
Yeah, there's usually a little bit of movement when there's earnings season, week to week. Just because there's companies that just have earnings that go crazy on the stock market, and we've got a couple of those I guess we'll talk about today. And then there's companies that just people don't like it.
Yeah,
it's kind of amazing how much stocks can move on just a quarterly earnings.
It's bizarre.
It is bizarre. I mean, you have stocks that move 20% in a day or 30% in a day, and it's just like, really? And business value went up that much?
Yeah, exactly. That's exactly what I always think back to. Is just like the value of a business changes quite slowly. The actual business itself, it might get better slowly over time, but like there's no way that you could wake up one day and your company suddenly be worth 20% more as a business. Yet that's what stock prices do. It's just phenomenal.
Yeah, it's just what is it? A voting machine in the short term?
Yeah, exactly right.
Just people's expectations, and they change a lot very quickly, and it's amazing to watch. And we're going to talk about some very interesting changing perspectives on companies. I mean, there's one particular one in here, and we're going to talk about it for hours.
Hours. Strap yourselves in. This is going to be a 6-hour podcast.
This is a 24-hour podcast.
Oh my gosh. You know, I've seen some YouTubers do like 24-hour live streams. I just couldn't do it. Man, I could not do it. Imagine being live on the internet for 24 hours straight. Whoa. Anyway, that's off topic. Let's get into our first company. What do we got first?
Yeah, so the first one I thought we'd talk about was Chipotle Mexican Grill. So, especially for those who are kind of following Phil Town, I guess, and value investing and that sort of stuff, you probably have looked into Chipotle or heard about it because Phil Town doesn't stop talking about Chipotle these days.
He loves it.
He does. But yeah, so Chipotle reported their third quarter earnings. So here are some of the numbers. Revenue came in at $1.4 billion, which was up 14.6% year over year, which is really impressive for a restaurant chain, if you really think about it. And that was driven mostly by comparable restaurant sales, which were up 11%. So this comparable restaurant sales, for those who don't know, it just measures the sales in the stores that existed for at least a year. So it's kind of like taking the sales growth and taking out the fact that they built more restaurants and that sort of thing. Just the sales growth in the particular restaurants.
Yeah.
And that grew at 11%, which is really, really high.
I feel like that's really good. Do you know just by chance, how many stores they've got total?
The number of stores they have at the moment is 2,546.
Oh, jeez. So across the board, across those, not counting the companies that they added in like the last year, out of those companies, the average increase in sales in that store was 11%.
Yeah, restaurants. Yeah.
Wow. Restaurants. Yeah, that's amazing.
Yeah, it is. And we can go a little bit more in depth into what is driving the sales increases in those particular restaurants. So out of the 11%, 7.5% of that 11% came from transaction growth, which is essentially more people transacting with the business, the number of transactions. And that, again, is a huge increase in the number of people who are visiting Chipotle more frequently. And it's a really positive sign, because if you don't know what happened with Chipotle, I believe it was in 2016 or 2015, there was a fairly substantial E. coli outbreak at a number of the restaurants in the US. And that resulted in massive declines in how many people were going to Chipotle restaurants naturally.
Right.
I mean, it's not really a surprise that people wanted to stay away from a restaurant.
People don't want to eat E. coli.
Yeah, it's not something you seek out when you're going to eat.
It's not a delicacy, is it?
That's the thing about restaurant companies, is they're kind of walking on eggshells their entire time, because
for sure.
If there's just, like, I know for myself personally at least, if there's a place I know that I've been sick at, I'm never going there again. Like, I don't care if it's been a year, I don't care if there's new management, if it's been completely renovated, like, it's still in the back of my mind, and it's kind of like it's just a psychological flaw, I guess, or something. But that's kind of what
it's hard.
Restaurants have to deal with that.
It's hard when the primary product that you sell has the potential to make someone very sick. And like, it's not too much of a stretch for your product to make someone sick. Like, it just has to be cooked poorly or something like that. Whereas like Apple or a technology company is not going to face that problem. It's like, I just feel like that's just an added complexity of running a restaurant, is that there's always a risk of the food that you serve someone being not great and making them sick. Because you're right, if you get sick at a restaurant, you're never going back. You're never going back. You'll be so scarred, especially if like people that have had food poisoning or something, and how bad of an experience food poisoning is. It's just like, you'll do anything to avoid that.
Pretty much. Yeah, so I mean, it's a huge positive to see that Chipotle is getting 7.5% growth in their transactions. People are coming back. And
gaining popularity.
And that's been a massive driving factor on their top line. And if we go and have a look at their bottom line, their profits, so their adjusted earnings per share came in at $3.82, and that was up 77% year over year.
Right.
So
what do they mean when they say adjusted?
Yeah, so
I never quite understand that.
Yeah, so there's the earnings per share number that you will see on the official financial statements that come out of the company, and that's called GAAP.
Right, so it's GAAP and non-GAAP, is it?
Yeah, so there's GAAP and non-GAAP, and adjusted means non-GAAP, and essentially management has just removed certain items that they think don't represent the ongoing operations of the business. And in this circumstance, those changes were, there was some impairments related to some of their long-term assets, so some non-cash charges, and then some restructuring costs that they believe are just something that's happened this year.
Right. So it's kind of like a one-off. So to get a better picture, you exclude them, and you can use a non-GAAP number instead. So that'll be a non-GAAP number for EPS.
Yeah, and while we're talking about this, it's super important that if you ever are using or looking at non-GAAP numbers, you need to understand what changes management is making, because this is one of the ways that management can manipulate you into thinking that they're more profitable than they are.
Than what they are.
Because they might just remove, restructuring costs, for example, they're real costs. And if a company is constantly removing these and saying, oh, they're not normal parts of our operations, but if they're happening every year, they might they might give the impression that they're profitable when in reality they're a lot less profitable or even making a loss.
Right. Yeah.
Yeah, so anyway, in terms of how many stores they opened in the quarter, they opened 25, which is actually quite low for what they normally open. So that brings the total, as I said before, to 2,546 restaurants. Something else interesting that came out of this was that they've been trialing what they're calling the Chipotle. I really like that. And it's a drive-through service, obviously.
Yeah.
And essentially, as a result of the effectiveness of having a Chipotle, I'm just going to call it a drive-through. I can't do that with a straight face.
You can imagine, just like the companies, don't call it a drive-through. It's a Chipotle. Don't call it a drive-through. What's the difference? It's a Chipotle.
Yeah.
Anyway, keep going.
And so they've been doing some renovations to allow, and they've been moving some restaurants to allow for drive-through, because I guess some of the restaurants are in locations where it's not possible. So they've been demolishing those and moving them around. And they're expecting to have 60 drive-through Chipotle restaurants by the end of the year. So still a very...
Do you mean 60 Chipotlanes?
This is 60 Chipotlanes, yeah.
Yeah, okay. Right, good.
And the purpose of this is just to capitalize on the growing trend of digital ordering. So people are a lot more doing orders through things such as Uber Eats, or what have we got? Deliveroo? That's a real Aussie one.
Yeah, Deliveroo. Yeah, that's true. Is there one like Menulog or is that another one?
There's a bunch of them now.
There's a few of them. Yeah.
Yeah, and and on top of that, people just doing mobile ordering and then wanting to just pick it up and just leave really quickly. And all of that is enabled through having a Chipotle. So that's what they.
Thank you for using the correct terminology there. I appreciate it. I'm sure the executives do as well.
Yeah. All the executives that are listening to this podcast right now.
Oh, I'm pretty sure the entire board of directors is listening to this.
Yeah, pretty much. I wouldn't be surprised.
They should be.
Yeah. No, but that's all I had for Chipotle. The stock was down actually on earnings, which kind of surprised me because the earnings were so impressive, just from my understanding. The stock went down 4%, but to be fair, the stock is up 85% this year.
Right. So, man, Phil Towns getting richer and richer.
Yeah, I'm sure we'll hear him talk about that a few more times.
Yeah.
Hey guys, remember that time I invested in Chipotle? Yeah, we know, Phil. We know.
Yeah.
We know. We've heard it. We've heard it before.
Yes, Phil. Nah, I love it. It's good because we should knock him because he never used to talk about anything that he owned.
Yeah, that's
so
true.
He always used to say, "This is how you do it. This is how you do it. This is how you do it." And then it's like, well, tell us, like, give us an example, dude. And now he is. So that's pretty good.
Yeah, can't knock the bloke. Just a bit of banter between colleagues because we're just friends, you know.
Bit of bants, yeah. You and Phil. You go back. There was that time. I remember that time where you bought his book.
I read his story.
You read his story, exactly. You're basically besties.
Exactly. Yeah.
All right, what do we got next?
The next company we had is another restaurant chain, is McDonald's Corporation. So McDonald's Corporation.
Macca's.
So in terms of their revenues, so system-wide revenues came in at $26 billion, which was up 5% year over year. So in terms of what system-wide revenue means, this is the total amount of revenue generated by all of the McDonald's restaurants out there. And the reason why this is different from the revenue that McDonald's Corporation receives is because most of the restaurants are franchises. So McDonald's Corporation doesn't actually receive all of that revenue. They just receive a portion of it. And the remaining of that revenue goes towards the independent business owners of each of those McDonald's restaurants.
There you go.
Yeah, so that's kind of interesting. And so what really has been happening with McDonald's has been that they've been consistently going from having less company-owned restaurants to more franchised restaurants. And the result of that is that their actual company revenues have been going down for quite some time because they've been receiving less revenue. But at the same time, they've also been taking on less costs. So it's kind of an interesting situation where their company revenues have been going down, but their earnings have been going up, which is as they become more efficient. So I thought that was kind of interesting. It's an interesting...
Actually, we'll talk about this. That's what happened to Tesla in the most recent quarter as well. Their revenues went down, but their earnings went up, and it's because they were so efficient at cutting costs.
Yeah. Yeah, no, that'll be interesting. Don't jump the gun with Tesla, all right? We'll get to it, okay? I know you're on the edge of your seat.
Jeez, I'm just chomping at the bit right now. Come on, let's get there. No. I wonder how many worldwide stores there are for McDonald's.
There's a lot.
Considering there's only 2,500 Chipotles.
30,000 is the number.
Is it 30,000?
Yeah.
Wow, that's unbelievable.
Yeah.
Wow. So yeah, and I wonder what percentage of them are franchise. You'd imagine I guess a fair few.
It's between 90 and 95%.
Oh, so mostly franchise.
It's mostly
right,
franchise.
okay.
They're just starting to... They've been in a constant move of reducing the number of company-owned ones, because when it comes to the company-owned, that is one structure that businesses can go by, but it means you receive more revenue, but then you have all of the operating costs. You have the staffing, you have all of the operating costs, really. But when you're just a franchise, they just receive a royalty from these companies, so from the restaurants. So for the most part, all of the costs, the hiring, the day-to-day operating costs are all on the independent business owner who's just running the one McDonald's, and then McDonald's just receives a royalty. So it's kind of a lower cost business model. So it's easier. Yeah.
Yeah, it's an easier business model to run with.
Yeah.
I guess, that makes sense, especially when you're that large. To have a franchise system is helpful.
Definitely. Once you get to that size, it's very hard to remain efficient. I mean, it's very difficult. It's amazing that they've been able to get that big, because the trade-off that you make with going with a franchise is that you're putting a lot of trust in independent business owners to maintain the integrity of the McDonald's brand. It sounds like a funny thing to say, integrity of the McDonald's brand, but it really is a thing. And the fact that pretty much every McDonald's you go to in the world is pretty much the same experience is impressive. Seriously impressive.
Yeah. I remember that was a key plot point that they had in that movie about McDonald's. What was that movie called? Is that the one that's called Founder?
Founder, correct. Yeah.
Founder. Yeah, that was an interesting plot point where the I can't remember what his name was. The original guy that started franchising him. He was going around to all these different...
Ray something.
Ray. Yeah, Ray. I can't remember. Anyway, he's going around to all these different franchise restaurants, and they're like making fried chicken and tacos on the menu.
One of them had tacos.
He was like, what are you doing? Like, McDonald's is McDonald's. We have the menu. We've got our system. Don't mess with it. Yeah. And then all the franchisees are like, oh, no, people love tacos. Come on, what are you talking about?
Yeah, no, it's fascinating. But so when it comes to McDonald's, if you're looking at McDonald's and how successful, sort of just trying to analyze their numbers, you have to look at system-wide revenue as well, because ultimately that's the revenue increases, or looking at the total revenue generated by the restaurants, and that's a better indication of, like, I guess the health of the company. So that was up 5%. In terms of the revenue that they actually received, so what comes to McDonald's Corporation, that was 5.4 billion, and that was up 1% year over year.
Okay.
And then in terms of comparable store sales, so same as what we were looking at with Chipotle, the growth in sales in particular restaurants, this was up 5.9%, which is really impressive. And anything above...
Especially for something so large, I imagine.
Yeah, anything above 5% is very impressive. I mean, 11% was just crazy with Chipotle, but 5.9% is very impressive for something of the size of McDonald's. And then in terms of earnings per share, it came in at $2.11, and that was flat year over year. So no growth in the earnings.
Right. Okay. Yeah, I can imagine, especially with McDonald's being just so large, like being everywhere, even having a slight increase in averages is quite impressive. Because obviously there's just so many of them. So Whereas if you have fewer stores, if you can lift the average, then it's like, oh yeah, that's good, but it's like not such an impressive feat if you had like 2,500 stores opposed to like 30,000 stores.
Yeah, I mean, to still get more people coming through the door and more people spending a lot more money at McDonald's stores is just, it's impressive. I mean, because at this point it's so, I mean, it feels so saturated. You see a McDonald's everywhere.
Sure. Yeah, for sure it's saturated. Absolutely. Yeah. One metric that I haven't seen you written down, I'm curious if you know this just off the top of your head. How many Chipotlanes did they add in the last quarter?
How many Chipotlanes did they add?
Yeah. Did they add many Chipotlanes?
I don't know. I don't know.
No, I don't know. We'll have to check that. We'll get back to you guys next week on that one.
Just start the podcast next week. By the way, guys, for those who wanted to know, Chipotle announced 14 Chipotlanes in the third quarter.
McDonald's and Chipotle have done a massive deal with each other. All McDonald's drive-thrus are now going to be Chipotlanes.
They should have called it the McLean.
The McLean. I think it's just more effort than what it's worth. Come try our revolutionary McLean. So isn't that just a drive-thru? Yes.
No.
Anyway. All right, shall we move on to the next company?
Yeah, what have we got next?
All right, let's hit up eBay. Let's get through eBay. eBay, I don't really follow this company. I did a little bit of looking into their results, and it really seemed pretty boring, to be honest. Their earnings per share actually came in at 37 cents per share compared with 73 cents per share in the year ago period. So a fair decline there. Overall revenue was flat at 2.65 billion compared to the year ago period. What did analysts estimated earnings of 64 cents a share, and revenue of 2.65 billion. So they got the revenue right, but the earnings wrong. So overall, eBay, just looking at their numbers, it just seems like eBay's just not growing, but it's just a cash machine. So, for instance, they generated $1 billion of operating cash flow and $913 million of free cash flow.
Wow, their capex is really low.
Yeah, it's not high, is it?
No, that's.
I mean, well, you think about just like business models in general. I mean, will they really need that much capex to maintain or to grow an online platform?
That's true.
I mean, some might argue that they do, or something, to maintain a competitive position or something, but at the same time, it's certainly not like a retail store or a retail brand with physical stores and that sort of stuff. Doesn't take that huge chunk of capex.
For sure.
But overall, Q3 free cash flow, what does it say here? Up 140% year over year, driven by lower taxes, working capital timing, and lower capex. Nice. So interestingly, they're still growing their active buyers. This is one stat that they follow. Their active buyers is now up to 183 million people in the trailing 12 months, and this has been growing pretty consistently at 4%, and now is no exception. They're still growing at that rate. But overall, even though their active buyers are rising, their revenue just isn't growing. It's just basically staying flat. Pretty much the way I look at eBay, it's just a money-making machine that isn't growing very much. So, for instance, they returned $1.1 billion to shareholders through share repurchases and cash dividends.
Right.
In I believe in the quarter. I'm not sure. Maybe that's in the trailing 12 months. I don't know. But yeah, that's kind of just what I took out of eBay, is that they're kind of just a stable company that's making lots of money, but they aren't really growing that much. They're not growing their revenues, they're growing their active buyers, but only slowly.
Interesting. And yeah, I mean, I guess even if they're not growing, they can still be a great investment. And I think Warren Buffett talks about this. I mean, if you have a business that can produce a high return on what they have to invest, if they only have to reinvest a little bit and they can generate a lot of free cash flow, that can still be a great business, even if it can't grow, because they can continue to produce that amount of cash flow. Maybe they can get a little bit more efficient, and then they can just, if they have no internal investments to make, they can just throw it into dividends and share repurchases and funnel it back directly to shareholders, where we can go and find new businesses that have growth to invest them in.
Yeah, exactly right. Yeah, it's all about looking at the cash flow. Cash flow for owners.
That's it.
That is it. All right. But that's all I had for eBay. Should we move on?
Yeah, let's do it.
Oh, here we go. TESLA. Tesla. I say Tesla. How do you say it?
Yeah, I say Tesla too. What is it? Tesla?
Well, I don't know. I'm pretty sure it's Tesla, but everyone in America says Tesla. Elon Musk says Tesla.
Oh.
But who knows? I don't know.
Controversy.
Was it Nikolai Tesla or Nikolai Tesla?
That's exactly what I was thinking, but I don't know.
Who knows? So, yeah. Anyway, so Tesla. Wow, this is very interesting quarter for Tesla. If you haven't seen their stock price, their stock has gone absolutely bananas. It was at about 250, and then after earnings it bounced up to 300, so 20% in one day, and now it's bounced up to $330 per share. So it has absolutely skyrocketed after these earnings, and I feel like there's a fair enough reason for them to rise, but maybe not rise this much. However, Tesla, in their quarterly earnings report, they noted that they've returned to profitability. So they generated $371 million of free cash flow, which increased their cash at the quarter's end to $5.3 billion. That was a big talking point for the short sellers, as they're going to run out of cash. So they did a capital raise in the previous quarter, I believe. In the previous quarter. And that helped the cash position get up to about $5 billion. And now they've added another $300 million onto that number. So that's looking pretty nice. A quote from their report says, despite reductions in the average selling price of the Model 3, our gross margins have strengthened. Additionally, operating expenses are at the lowest levels since Model 3 production started. As a result, we returned to GAAP profitability in Q3 while generating positive free cash flow. This was possible by removing substantial costs from our business. So, yeah, you look at the revenue for Tesla and it's actually slightly down. However, they've really, the focus of Tesla over the past 12 months has just been to make this company super tight-knit financial company. Like, it runs efficiently, they're not wasting money, every dollar counts kind of mentality, and that's starting to really show, considering their free cash flow is so strong, their gross margins were stronger. So yeah, overall it was an impressive quarter. And this is, like, all these numbers, like free cash flow was so positive, but CapEx was still at its normal level. I wonder if I wrote down how much CapEx there was, something like 400 million or something like that. So yeah, really interesting.
Yeah, and I guess you would expect, maybe you would know a little bit more about this, but I guess you would expect a substantial amount of that CapEx is investments in the future, in growing the business. So it's not as if it's money consumed by the normal operations of the business. It's
not maintenance. Yeah. I mean, they're just foot to the floor, full growth mode at the moment. So they've got so many areas that they need to tackle with their capital expenditure. They've got to get, obviously, the Shanghai Gigafactory, which is now more or less complete. They're going to have the Europe Gigafactory, which they announced on the conference call. They're going to announce where that's going to be by the end of this year. Then they've got the Model Y ramp. They're going to have capital expenditure to get the Model Y production lines up and running and up to scale. Then the future, they've got the Tesla semi-truck, which they haven't built, in large volumes yet. They need to build those lines. They've got the Roadster, which is going to be a smaller, lower volume vehicle. And then they've got the pickup truck as well. So there's so many areas. Yeah. As well as that, they also want to try and grow the energy side of their business. So you'd imagine more CapEx in the battery production side of their business for things like mega packs and power walls and that sort of thing. So yeah, it's not like it's not like all that CapEx is going straight to maintenance. It's basically all, I would imagine anyway, it's basically all growth.
Yeah, no, it's really impressive to see that they're at profitability. It's just a fascinating story because I'm not an investor in Tesla or anything. I just kind of watch from afar. But it's always fascinating to see articles come out. Oh, they're not going to get profitable anytime soon. And sort of people just have all of these opinions, and then just to see them not come true.
Basically.
I guess, I mean, just because a lot of people base a lot of their investment decisions on just what, I guess, air quotes, professional analysts say, or like professional investors say. And I mean, the point of this is like kind of that everyone just has their opinion. And most of the time it's just baseless, just because they're on TV or just because they have a suit on.
Talking head.
Yeah, doesn't necessarily mean that they know what they're talking about, which is, it's interesting. I'm guessing a lot of the movement, the up movement in the stock price, the 20% that it jumped yesterday, and I think it went up another 10% today.
Yeah.
I'm guessing a lot of that movement was people with short positions getting squeezed and having to...
Yeah, they were saying that there's more shorts have lost over 1.5 billion in total over the last couple of days. Yeah. I'm seeing I follow a couple of Tesla bears on Twitter, and I've seen them retweeting that a couple of their short selling friends have been burnt out of the game.
Bowed out.
They've had to. They can't keep their position. They can't keep losing the money that they are. So a few of them are starting to get burnt. And
there was someone, I think it was Steve Easman, has a short position.
He does.
In Tesla.
Yeah. He does. Yeah. So he'd be feeling the pinch at the moment. Yeah. I mean, I can understand why people have shorted the Tesla, because, you know, you're right. If you look at their balance sheet and the rate at which they are, you know, just funneling money into trying to grow their business, like, it's not the best balance sheet in the world. There are certainly better balance sheets out there, better financial statements. But I mean, you're just, the way I see it is that there are so many revenue growth drivers for Tesla in the next 10 years. So many options for increasing their revenues quite substantially. And they're being led by, in my opinion, one of the best CEOs of a public company we've seen in a very long time. One of the common things that Tesla bears say is that, oh my gosh, I can't believe you actually trust Elon Musk and what he says. And that's fair enough to an extent, because obviously the common thing with Elon is that he's very commonly incorrect with his timelines. But if you rewind the clock 10 years and have a look at the master plan that Tesla said that they were going to do for the next 10 years, from Roadster to Model S to Model X to Model 3, and how they wanted to implement that, if you read what they wrote like 10 years ago, they have done exactly what they said they were going to do. And for that reason, that gives me very high confidence in the management team that whatever they say they are going to do for the next 10 years, they will do it. So a lot of people don't trust Elon Musk, but for me, looking at what he said he was going to do through to what he's done and how precisely that matches and how he has been able to do that. And now, you know, Tesla is a much stronger company financially now as to what they were 10 years ago. I have no reason to believe that won't continue for the next 10 years.
Yeah.
Does that kind of make sense?
Yeah. I mean, I don't really get why people don't trust Musk. I mean, if you look at, it kind of comes back to that short-term, long-term view thing again, like what you said, like his long-term plan and what he said was going to happen is happening. But if you kind of just zoom in on one thing that he says, okay, in the next quarter, this is going to happen, and it doesn't happen. I mean, yeah, of course he's going to be wrong. And maybe he talks a little bit too much on Twitter and stuff like that. But I mean, I think what's important is what you said, is that he's making long-term goals and hitting them.
One of the
go on.
I was going to say, one of the interesting things is, if we rewind the clock like a year or over a year now, there was the period of time where the Model 3 was ramping up and they were really struggling, and the ramp ended up progressing quite slowly, and it was delayed by about a quarter. The ramp was delayed by about a quarter. Right. And it was interesting, on the conference call around that time, Elon was saying, yeah, okay, we're having some issues, but you got to remember that this car has been like 10 years in the making. So when you think about it as a long-term, project, what's 3 months in the grand scheme of something like 10 years, it's really not that bad. But of course, that's not the way that Wall Street works. So
yeah,
I guess that's why you saw the stock get crushed when they were saying that they were having problems with Model 3 ramp. But I mean, long-term trust in management, we look back on that now, and they just had record deliveries of 97,000 vehicles. Just like, man, yeah, it seems insignificant now. Man, they had problems with the ramp, but I mean, they're pumping out 97k vehicles a quarter now. It's just ridiculous.
Yeah, as long as the demand remains, I don't see Tesla having any problems. My concern from an outside view is if there's some kind of long and painful recession. Because car companies are very cyclical. It's one of the things that people try and put off buying when they're strapped for cash. And that would that's obviously the biggest concern. Whether or not it's, a probability or a possibility, that's another thing. But for someone who's analyzing this industry, but yeah, I mean, that's the biggest concern is, if we went into a recession right now and demand dropped by 50%, is $5.3 billion enough to get you through?
Yeah, and that's a fair opinion to have. And Tesla would be, I believe, particularly hard hit because all of their cars are still premium vehicles. Like the cheapest Model 3 costs 70,000 Australian dollars. Yeah. So especially when it comes to, like, you can think about, okay, some people might need to buy a new car in a recession, but if a recession hits, they're probably not going. Like the first thing that gets cut is the sales of luxury vehicles. Yeah, as people try and save money.
Yeah, and particularly with luxury vehicles, a lot of people like to finance them. And another thing that will happen in a recession is it's likely that it'll be more difficult to finance purchases. That's just something that kind of happens with a contraction. Yeah. So, I mean, as I said, I just have a very outside perspective. I have no bets either way on this. I have a bet kind of in my mind that I would love the company to succeed because I love what they're doing. But,
yeah. Oh, I love it too. Like I hold this company only as a very speculative position. Like I would be totally comfortable if I lost I wouldn't be totally comfortable, but it's a real possibility. Yeah. I understand that it is a possibility that I could lose money on this position because it is very speculative. For me, my speculative investment is Tesla is more about this is a future that I want to see.
Definitely.
And they're run by a person that I believe is, revolutionary. He's super smart and he has a long-term history of executing what he says he's going to do. So I feel comfortable investing in it. But as I said, if you follow the method that we follow, like the value investing approach and Warren Buffett's approach, you would find so many flags in Tesla. So that's why I always say, yep, this is speculative only. But with that said, there's just a couple more things to come out of like the conference call and whatnot for Tesla. The Gigafactory in Shanghai is now kitted out and they're actually producing trial Model 3s already, which is pretty cool. As well as that, they're ahead of schedule for the Model Y, and they're also already producing trial Model Y cars. And then from what else did I pick up from the conference call? Oh yeah, you can now lease solar panels from Tesla with no money down. So basically, you can put solar panels on your roof and can immediately have a money printing machine on your roof, which is pretty interesting. And Elon's made it specifically like that so that consumers can take advantage of that. You stick our panels up on your roof and you can immediately start printing money. Another thing that I got out of the conference call was that full self-driving early access will be released hopefully. Well, he said it'll be ready by the end of the year. He was noting that there's kind of 3 stages to full self-driving. He was saying that the first stage is when it's feature complete, but it needs constant human supervision.
Right.
Then the second, so he thinks that they'll get there by the end of the year. And then he thinks that the second stage is where they've got full self-driving, it's feature complete, and Tesla believes that nobody needs to drive the vehicle. You could go to sleep. That's in Tesla's opinion. And then the third stage is when it's full self-driving, feature complete, and the regulators believe that as well. Okay. So So there's three, yeah, and obviously Tesla, that this is what they can say in their conference call, they have control over the first two numbers. The thing that they don't have control over is the last number. However, even with that last stage, they work with regulators to try and get them on side and show them how safe the car is and that sort of thing. So thought that was interesting as well. Two more points. Version 3 of the solar roof, I was just listening to the call before Elon just released that V3 of the solar roof is now available, and they're going to be scaling up the production of that roof. They've finally done enough testing on it, and the thing I mentioned before was that Gigafactory Europe will be announced by the end of the year. So that were my main takeaways out of the conference call.
Jesus, we've got a lot going on.
I know, right? This is... if you're just getting started with investing, this wouldn't be an easy company to dive into and learn the ins and outs of. But again, the complexity, well, not even complexity, but just the amount of stuff that they're doing.
Yeah.
It kind of makes me excited, because all of these other areas that Tesla have been working on in the background are so insignificant compared to the auto side of their business. But they're insignificant because they're so capital constrained, they're so capital constrained that they have to focus their efforts into the auto side of their business. So once they got more money and they start pumping, effort into ramping up solar production or battery production for grid scale storage or new gigafactories and whatever, there's just so many potential growth drivers into the future. That's what I find really interesting. But how long did I take talking about Tesla? Was that
I don't know, actually. I feel like it wasn't that long. I feel like it wasn't that 10 minutes at most.
I tried to restrain myself to just the key points. There's just a lot of key points. Anyway, shall we wrap up Tesla and get into the next one?
Yeah, let's do it. So the next one we had here was Boeing. And maybe I'll just read through some of the basic numbers, and then you can give us a bit of a story about the 737 MAX. So in terms of some of their core numbers, earnings per share came in at $1.45. That was versus the expected, which was $2.09. So they missed on earnings. And then revenue came in at $20 billion versus $19.66 billion. So they scraped through expectations in terms of revenue. In terms of the last 3 quarters, revenue has fallen from $28 billion to $23 billion to $16 billion. Wow.
Yeah, it's dropped.
Substantial. And in terms of the last 3 quarters for earnings per share, it has dropped from $6 to $4 to negative $5. Wow.
Yeah. It's pretty crazy. Last 3 quarters free cash flow, $2.4 billion to $2.2 billion to negative $1 billion.
Ouch.
Yeah. And the scary thing about that is that the least CapEx was in the most recent quarter of $400 million for free cash flow. Yeah. So, yeah, this is where... this is an interesting case. You know how we're always talking about, reasons that companies might come on sale, and we're talking about company-specific short-term events or industry-specific short-term events or market-specific short-term events. I think Boeing is stuck in 2 out of the 3 of those. So what we're seeing, basically a couple more numbers for Boeing. They delivered just 62 airplanes in the quarter versus 190 planes in Q3 of last year.
Wow.
So really choked. However, they are sticking with the guidance that they'll get regulators on board by the end of Q4 for the return of the 737 MAX. So this is really the core of what's been going so wrong for Boeing. So the story of the 737 MAX is a new aircraft that basically, after a year and a bit of operation, the 737 MAX had been involved in 2 fatal accidents, both of which occurred within 5 months of each other, and both of which occurred for the same reason. So basically raised so many safety concerns, and it prompted airliners to just ground all of the 737 MAXs. And in both accidents, the problem with the 737 MAXs was the new maneuvering characteristics augmentation system. I don't know the details of that, but I believe it's to do with the self-adjusting nose cone based on different angles of aircraft. Anyway. Right. What they found in both crashes was that the satellite tracking data showed that after takeoff, both of the aircraft were just experiencing really extreme fluctuations in vertical speed. And in both instances, what they found is that the pilots of the planes radioed in before the crash saying that they were having real bad flight control problems. which is obviously not something as a aircraft manufacturer that you want to hear because it's really battered Boeing's reputation a little bit. But they do expect most of the 737 MAX aircraft, most of them to be back in the air early next year. They're kind of a bit loose. So the problem here is that Boeing now needs to be certified again to continue building these aircraft. So it's really hurt their business in the short term. Basically, regulators have said, no, you can't make this. Right. So it's pretty rough on them. But they do say they're hoping to make 57 737 MAX planes per month by the end of next year. So they're hoping to try and ramp that back up. But they're also experiencing more problems, is that the tariffs are also hurting their business because the Chinese airliners, and China is the largest aviation market, they're currently holding off on ordering new planes from Boeing. So their orders are down from the Chinese airliners. And just to make matters worse, they've delayed the production of their upcoming new plane, which is the 777X, and that's now going to start in early 2021 as opposed to late next year. So you can see it's kind of interesting. They've got the company-specific event in the fact that their 737 MAX aircraft had massive problems, and they've got the kind of the industry-wide event in the fact that the tariffs are hurting their business. And this is just all compounded bad news for Boeing, right? Basically.
Yeah, so I guess I guess the positive from this is that there's an end to the problem on the horizon, I guess. What is true. It, the end of next year they're hoping to kind of get back to their normal production levels?
I believe they're hoping to get the regulators on board to let the planes fly again by early next year, and then they're going to slowly ramp back up their production of the plane over next year, hopefully up to a run rate. What did I say before? There was a run rate in there. 57 737 MAX planes per month by the end of next year.
Right, yeah, because I was having a look at the stock price of Boeing before, and I mean, it's kind of bounced around over the past year. It hasn't really gone up, but it didn't really go down substantially either. Yeah. There's an interesting reason behind that, and this is one of the few positives for Boeing, is that even though they've had all of these problems, the backlog of orders for the 737 MAX isn't declining too much. Right.
So they've got quite a backlog of the orders for the plane. So I think for investors, the way they see it is, this is shit. This sucks. But at the same time, they're just going to realize the revenue for this plane later than what they would have if this problem wasn't here. It's not like the 737 MAX is a failure of a plane. They've shut down. They're going to completely ditch the whole idea of the plane. They've still got all those orders. They just can't make the plane right now. They need to get recertified and then start making all of those fulfilling all of those orders. So I think that I was listening to a thing on CNBC, and that's what the analyst was talking about there, is that probably the reason that the stock price is being held up is because the orders of the 737 MAX haven't declined substantially.
Right. Okay. Yeah, that's really interesting because I guess the fact that most of the orders are still there, and that people haven't dropped off, it kind of indicates a little bit of a big moat that Boeing might have, quite a big advantage that Boeing might have over some of the other manufacturers, I guess.
I think they do. I think the top two are Airbus and Boeing. Yeah. And so, and I mean, it's an industry with obviously massive barriers to entry, huge barriers to entry. It costs so much to build these planes. So I think that no matter what, the market share is only going to be bounced around between a few players. So I don't think there's any other companies that can really benefit from this position that Boeing's in and kind of take over their market share.
Right.
Especially I don't know, basically every plane I've ever flown in has been a Boeing plane.
Yeah. I mean, I honestly...
I've never been in an Airbus plane,
No,
actually.
I don't think I have either. Yeah.
Yeah.
Interesting.
I believe that's the other company, isn't it?
It is Airbus, yeah.
I don't really... Airbus, yeah, because they make the A380s, but they're running into problems that they're not making the A380s anymore. Right. Because there's not enough demand for... They're those really huge planes.
Oh, okay.
I think the Airbus A380s.
Okay.
But anyway, I don't really know too much about the industry, so I can't really talk too much.
I don't either. Yeah. No, interesting. What was the other? So we have two more companies to talk about here. and we'll get through them in the last 10 minutes here of this podcast.
Yeah. I'll just, I don't follow Microsoft, so I really can't talk too much. I can just say what the numbers were. So the earnings were $1.38 per share, versus $125, $125. Oh my gosh, that's a big decline. Versus $1.25 per share expected by analysts. So they beat there. And then their revenue also beat 33 billion as opposed to 32.2 billion expected by the analysts. Stock really didn't move too much. It's up 1%. Nothing really happened. One of the quotes here was that the Azure public cloud business delivered 59% revenue growth, which was down from 64% growth of the 1 quarter earlier. Microsoft doesn't disclose Azure revenue in dollar figures, which is interesting. This is kind of the, I think, Microsoft's version of Amazon Web Services.
Gotcha. Yep.
But I don't know the industry too well. So if you're a tech guy out there, you could probably say, actually, Brandon,
you're wrong.
It's not. Yeah. But for all it seems as though it's the equivalent to Amazon Web Services. So yeah, overall, Microsoft a little beat on earnings, but the stock really didn't do too much, and that's pretty much all I can say about Microsoft. I don't really know too much about it.
Yeah, me neither. And I guess to sort of finish off, we'll talk very briefly again about Amazon. So Amazon, we've got a couple of numbers here. Another company I don't really follow Amazon at all. Do you follow Amazon?
Nah. I take one look at their PE ratio and I say, no, I'm not following this.
Yeah, it's Anyway, so their revenues came in at 70 billion for the quarter, which is just crazy. Which was up 24% year over year. So their revenue is still chugging on, not growing as fast as it was, last year, I guess, which kind of makes sense. But 24% is still very, very impressive.
Still amazing.
In terms of their earnings per share, it came in at $4.23, which was down 26% year over year. And just from reading the press release from Amazon, the decline in earnings per share was driven by sort of two factors. One was higher content spending. So they have their Amazon Prime Video, I believe it's called. It's kind of like a Netflix. Yep. It's their version of Netflix. So they've been spending a lot more money on content there. And I believe that they spent almost as much as Netflix this quarter on content, but not quite as much. Netflix is still the big spender in this space. And then the other cost that was higher, which caused their earnings per share to go down, even though revenue was up, was just higher general and administrative costs and that sort of thing. So, I mean,
you don't want those to snowball too high.
Yeah, it's an interesting business because the brand is built around their huge consumer platform, their e-commerce platform. But really, that platform itself is not profitable in of itself. So like the cost to fulfill and the cost to the cost of the goods that they're selling is actually higher than the revenue they generate from products.
Wow.
But then they have their services, which is very high margin, as you can imagine. Selling advertising, cloud data, Amazon Web Services, as we just said, their Amazon Prime subscriptions and that sort of thing. So yeah, it's an interesting business model.
Wow. Yeah, definitely. That really surprises me. I did not know that Amazon's core business doesn't run profitably. Their online shopping business. That's remarkable.
Yeah, well, I mean, I guess maybe that's a little bit misleading because in terms of the product sales and the product costs, that's not profitable. But then I guess when you include the Amazon Prime memberships, which is technically services, that's where their profit really comes from.
That's where they make their money.
It's kind of similar, not really. It's kind of similar to Costco, where in terms of the goods that they're selling, they don't really make a profit off the goods. It's the membership fees that they're making the profit off.
Right.
Yeah.
Yeah, no, that makes sense.
Actually, it is very similar to Costco in that way because Costco, you kind of pay a membership and you get exclusive access to cheap goods, and Amazon's kind of the same thing. You get exclusive access to discounts and to fast shipping.
Yeah.
There you go. Anyway, the stock was down 7% on earnings, so yeah.
Wow, that's quite a bit. But then again, I mean, when you get stocks inflated to such high prices, I mean, you got to kind of expect that if they don't come out with just absolute killer numbers, then you could see the stock fall quite a bit.
Yeah, exactly.
That's just part and parcel.
Exactly right.
But yeah, I think that basically rounds out all the earnings we've got for this week.
That's it. Should we do a Q&A?
Let's
do
sure.
one Q&A.
Have we got? I don't. Do we have any for this week? I think we do.
We've got a couple.
Okay, cool. All right. What do we got?
The first one is just a pretty basic question. What brokerage would you recommend, or what broker would you recommend for beginners?
All right. Oh, look. This is I reckon this would be the most commonly asked question that I get. Would you agree,
yeah.
Or do you see it differently?
Yeah, no, I get this one a lot as well. Yeah.
I get this all the time. And I've always said, for the longest time, I've just said, it's probably worthwhile if you just stick to whatever your bank is, because the biggest 4 banks in Australia, they have their own share trading services. And they're big financial institutions. Some would call them safer. So a lot of the times too, you get discounts or you get some sort of special offer if you go with their brokerage service and you already have a bank account with them. They'll give you some sort of customer special or something. So for a lot of beginners, sometimes I just say, just maybe just have a look at what your bank has to offer. I mean, there's lots of options out there. There's like Self-Wealth, CMC. There's so many apps and different brokerage sites and whatever that are coming online. But at the end of the day, sometimes it is just worth sticking with the financial institutions for the added security.
Yeah, that's kind of been my philosophy. I mean, you can just go and find the cheapest broker. I mean, there are brokers out there that offer $0 fees, and maybe they only charge you on transaction fees or something like that. And you can go with that. The sacrifice that you're making usually in those circumstances is kind of 2 things. One is security and one is customer service. If you go with a big major bank, you always know that you can go into a branch and you can talk to an actual person about it. Whereas if you're kind of using some online platform, you might save some money, but if you have any problems, it might be difficult to reach someone. I'm sure there are great online platforms, trading platforms that have good customer service. I'm not dissing all of them.
Yeah.
I'm just saying that that's generally the trade-off that you make.
And you think about the business, like if this is if this is a broker that as a business can offer brokerage-free share trading, where do they make their money? So, or another question to ask is how do they structure their business so that they're still profitable? And a lot of the times is that all of the added extras that the more traditional brokers offer is that these brokerage-free brokers just cut them. So sometimes that can lead to a cut in things like, customer service opportunities and that sort of thing. It's that they're trying to run their business as cheaply as possible so that they can still make money while offering their customers brokerage-free trading. So it's kind of just like a bit of a trade-off. You got to always look into with these brokers, okay, if it's really cheap brokerage, what am I forfeiting? And how is this broker then making money? That's the things that I would start to ask.
Yeah, it'll be something that I'm interested to see is that I noticed that a couple of the US banks have started to do this. There's none in Australia that's done it yet, but some of the US banks have started to offer no brokerage trading. And I'm interested to see if any Australian banks will do it, because when it comes to an Australian bank, say Commonwealth, for example, the amount of money they make from brokerage, from trading on their platform is so small compared to what they generate from their normal business, which is essentially taking deposits and lending them out to other people as mortgages.
Right, yeah.
So it'll be interesting to see if Commonwealth did that. Yeah, they'd take a little bit of a hit on their earnings, but it would basically kill every other business that's only doing brokerage free, because then it's like, well, do I go brokerage free with this small independent trading platform, or do I go brokerage free where I can go in and get advice and I know that there's that customer service and security. So I'm curious to see if some of the banks would do that. I mean, I would imagine that the banks could just offer brokerage free, and then wait for all the other smaller companies to go out of business and then just hike the brokerage again.
It very well could happen. It's probably a decent strategy.
Or charge $1 brokerage or something. I don't know.
Yeah, it is something crazy. Yeah.
We will see.
Oh, there you go. Should we wrap things up
there?
Yeah,
let's wrap it up. Thanks, everyone, for listening. And I forgot to mention at the start, but if you have a question for next week, go ahead and leave it down in the YouTube version of the podcast, which is on my channel this week. That's youtube.com/Hamish Hodder. Thanks again to our sponsor, HYPERCHARTS, for sponsoring this episode. If you did want to check out the premium version of what they're offering, or even just the free version of what they're offering, head over to www.hypercharts.co/premium. And you get yourself a free 2-week trial. So why not?
Indeed.
Do it.
Yeah. And that's it. Yeah. And that's all she wrote. See you guys next time.
See you later, guys.